Several prominent experts in the field of gold trading offer distinct perspectives and analyses on the current state and future prospects of gold prices, each influenced by their unique outlook. Here some prominent experts like Peter Schiff, Gareth Soloway, Eric Robertson, and others will share their unique perspectives on the future of gold prices, offering valuable insight for the investor. Gold prices have recently reached a 3-month high, driven by increased investor interest in the precious metal due to escalating geopolitical tensions and concerns about inflation. Factors contributing to this surge in gold's appeal include the ongoing conflict between Israel and Hamas, uncertainty surrounding the U.S. Federal Reserve's monetary policies, and the notable rise in global commodity prices. As a result, gold has seen a 2.2% increase in value this week and is poised for its second consecutive weekly gain. It's worth noting that gold prices are currently at their lowest point in several months, which could present an opportune moment for investors to consider purchasing gold at a relatively lower cost. 1. Peter Schiff, a renowned gold enthusiast and the CEO of Euro-Pacific Capital. Peter Schiff is highly optimistic about the trajectory of gold prices and contends that anything below the $2,000 mark represents a favorable buying opportunity. His outlook is underpinned by the belief that gold is poised for a significant breakthrough from its current trading range, primarily due to the convergence of favorable fundamental and technical factors. Schiff goes on to make a bold prediction that gold will reach $5,000 per ounce, foreseeing a scenario in which the Federal Reserve opts for increased quantitative easing rather than monetary tightening. He argues that the U.S. economy is in a weaker state than commonly acknowledged, and that inflation is set to worsen. He highlights the fact that gold is currently trading below production costs, a result of surging inflation, and suggests that mining companies will not invest in exploration until gold prices reach the range of $2,500 to $3,000, which could lead to a supply shortage. Moreover, Schiff questions the ongoing decline in gold prices despite rising oil costs, asserting that gold should logically be on an upward trajectory. He warns of an impending crisis as elevated oil prices have the potential to increase energy costs, debt servicing expenses, and the prices of nearly all other commodities. Schiff advises investors to hedge against inflation and currency devaluation through investments in gold. Schiff challenges the prevailing logic in the gold market, which dictates that gold rallies in response to signals of abating price inflation and declines when there are signs of economic weakness. He contends that investors are right to buy gold as a hedge against inflation, but he disputes the notion that inflation is diminishing or that the Federal Reserve is successfully combating it. According to Schiff, inflation is bound to intensify, and the Fed is not effectively addressing the inflation challenge. Peter Schiff's analysis suggests that gold presents an attractive investment opportunity, with a bullish outlook driven by multiple factors, including an anticipated increase in inflation and a weakening economic landscape, all of which make gold a valuable asset for those seeking to safeguard against currency devaluation and inflationary pressures. 2. Gareth Soloway, an analyst, shares a bullish perspective on gold. He believes that gold is primed for an upward trajectory, considering it a buy as long as it remains under $2,000. Soloway predicts that gold will soar to $5,000 per ounce, attributing this projection to expectations of increased quantitative easing by the Federal Reserve and concerns about the U.S. economy's weakness and escalating inflation. He also notes that gold's current price, below production costs due to rising inflation, could lead to a supply shortage, with mining firms hesitating to invest until gold reaches $2,500 to $3,000. Soloway questions the declining gold prices amidst rising oil costs, highlighting the potential for a looming crisis driven by higher energy and commodity costs. He advises investors to use gold as a hedge against inflation and currency devaluation. 3. Eric Robertson, the global head of research at Standard Chartered, sets a target of $2,250 for gold. He attributes this positive outlook to the low interest rate environment, the weakening U.S. dollar, and increasing inflation expectations. Robertson believes that gold will attract more demand from central banks and investors as a diversification and hedge asset. 4. Analysts at Swiss Asia Capital suggest that gold could potentially rise to at least $2,500. They emphasize that if America's economic challenges deepen, the price of gold might even reach $4,000. They cite concerns about a U.S. debt crisis, a currency crisis, and political instability that could undermine economic stability and the credibility of the U.S. dollar. They also highlight the diminishing reserve currency status of the U.S. dollar, positioning gold as the ultimate safe haven. 5. Przemysław Radomski, a market strategist at KITCO, shares a similar bullish sentiment regarding gold. He believes that gold will break out of its current trading range and continue to rise, projecting a target of $5,000 per ounce. His outlook is based on expectations of increased quantitative easing by the Federal Reserve. 6. Ali Yale, a financial journalist at CBS News, anticipates gold prices rising in 2024, followed by a period of stability. She attributes this to various factors, including inflation, Federal Reserve policy decisions, the geopolitical climate, and the upcoming U.S. presidential election. Yale notes that expansive fiscal policies, such as increased government spending and tax cuts, leading to inflationary pressure, could boost gold demand as a hedge. 7. Chris Vermeulen, the founder of the Technical Traders, emphasizes that gold prices are influenced by multiple factors, including gold supply, the value of the U.S. dollar, demand from central banks and investors, and market trends. He advises investors to closely monitor market dynamics and diversify their portfolios with assets that can serve as hedges against different types of risks. The ongoing conflict between Israel and Hamas has increased the demand for gold as a safe haven asset. Gold is often sought as a hedge against geopolitical risks due to its ability to preserve value during times of uncertainty and turmoil. This is because gold is dollar-denominated, making it a hedge against inflation. From an economic perspective, gold is considered a safeguard against inflation, currency devaluation, and geopolitical uncertainties. In times of instability, investors tend to turn to gold to preserve their wealth and minimize potential losses. Gold is also recognized as a universal currency that can be traded globally. The uncertainty surrounding the U.S. Federal Reserve's monetary policy stance has raised expectations of inflation and lower interest rates. Inflation erodes the purchasing power of paper currencies, and lower interest rates reduce the opportunity cost of holding gold. Both of these factors contribute to gold's attractiveness as an alternative store of value. As Goldco suggests, as inflation rises, so does the price of gold. The surge in global commodity prices has further driven demand for gold as a hedge against inflation and currency devaluation. Prices of commodities like oil, copper, iron ore, and grains have witnessed significant increases due to supply disruptions, rising demand, and speculative trading. This surge in commodity prices has had an impact on the cost of living and production for consumers and businesses globally, and has also put pressure on some emerging market currencies that rely on commodity exports. Gold serves as a means of protection against these risks, maintaining its purchasing power and acting as a universal currency. Thank you for watching this analysis on the recent surge in gold prices and expert opinions on the subject. If you found this analysis informative and would like to stay updated on financial trends and expert opinions, please consider subscribing to our channel. We'll continue to bring you valuable insights to help you make well-informed investment decisions.